Thank you and welcome into this video. I would like to take you through some of the contentious clause passed in the Finance Bill 2026-2027 that was officially passed by the National Assembly on June 18, 2026, though the high stake of electronic division of voting, where 112 members voted toward the bill and 40 members voted against the bill. The registration was aiming to raise 98.9 billion in fresh revenue in order to fund the government fresh budget of 4.8 trillion for the fiscal year 2026-2027. So the bill is waiting to be signed or to be assent by the president. But in this scenario, I would like to deep dive into the most contentious clause passed by the finance bill, which was passed technically by the parliament, though not everything that was proposed by the national treasury really gotten through the parliament. Some of the clauses were dropped due to public pressure, not rather the need of parliament to drop the clauses. First thing first, I would like to dig deep on the first controversial clause, which is the clause which was deeming distribution of dividends, which they are calling the 60% rule. What this rule suggests is that private companies that do not declare or distribute their dividend within 12 months from the end of the financial year will automatically be treated as having distributed at least 60% of their after-tax profit. So this is a clause which is suggesting that private company, which in most cases usually reinvest the dividend rather than paying out the dividend, even if they treat their dividend as retained earning, it will be deemed as it was the 60% rule is deeming like the 60% of the dividend were paid to the owners, and it will be attracting some taxes, which is the withholding tax. So the backlash on this, this triggers an immediate withholding tax on the retained earning, where business is arguing that it will cripple the growth as companies are forced to pay taxes on cash they intend to reinvest back into the expansion or operation. So this is what it will happen, because the government will be taxing the retained earning by the company using the 60% rule, assuming that the 60% of the dividend was paid out. But this dividend in most scenarios, they are reinvested in the business, so that they can try and maximize their profit margin. But now, even if this dividend they are not paid, they will be assuming that 60% of this dividend were paid out, and they will be subject to the withholding tax as paid out dividend. So this would discourage the reinvestment or reinvesting back this amount to expand the business, and this can limit the capability of private sector to expand, because a lot of private business in most cases usually invest the retained earning to try and spur the investment and develop the infrastructure so that the business can develop. So this in most scenario doesn't make a lot of sense, because even if this company do not declare this dividend, or they declare them and then maintain them as return earning, they end up paying the corporate tax and other taxes, which the government will be able to net off or to offset the dividend which were not paid off. So in holding all the other factors constant, this is a punitive tax which it doesn't make sense. Why pay withholding tax or something which was not paid out by using the assumptive or pre-assumptive withholding tax that these dividends were paid out to the owners, but rather they were reinvested back to the business. So this is one of the contentious area in the bill. The second contentious clause in the bill was the clause which was reclassify essential good and digital fees as royalty. Okay, the clause is expanding the classification, is reclassifying goods and digital fee as royalty. So this is reclassification of essential good and digital fees as royalty. So what this happen is where software fees, card scheme, and digital payment network charges are recharacterized as royalty or professionals fee. So technically, by doing this, they will be attracting a withholding tax at a rate of 5% in a lot of cases. The backlash to this is these subject digital platform operators and payment network to an immediate withholding tax, as I said, combined with the removal of the VAT exemption on the payment processing of the gateway services. It is being predicted there will be a sharp rise in the transaction fee for consumer who are using credit card, mobile wallet, and online payment gates. So technically, this will be discouraging people from mobile payment or digital payment, and it will be driving people back to the cash which we have been learning away from and saying we are going to a digitalized economy. But now this is dragging us back because there was also removal of VAT exemption on payment processing and gateway services, which had been made in order to spur the growth of these services. But now they have been gotten, and this will be attracting some withholding tax, which the burden of the tax will end up being passed to the consumer again. So the consumer is the one who usually bear this cost, rather than in most cases the producer will have to pass the burden to the consumer, who now will start now looking for alternative measures, now leading to closure of some businesses, because these gateway and payment method and the credit card business and the mobile wallet, they are business of people who operate these businesses, and they employ some people. So the net effect the ripple effect must be felt in the economy all in all, and also will be driving people to, how I say, to informal transactions which are not monitored easily. Also, there was also an introduction of scrap metal turnover tax. There is a new 51.5 withholding tax in scrap metal stamped on the gross proceed of the scrap metal sale. So the feedback effect on this is that it will be affecting the scrap metal business, where the cost of doing scrap metal business will be rising day in, day out. But in its High Court petition, the Consumer Federation, or COFEC, point out that the taxing the gross turnover rather than the actual net income disappropriate the low-income youth and waste pickers and small-scale dealers who survive on paper-thin margins. So a lot of people have been employed by this sector of scrap metal, such as the waste pickers, who really have helped in recycling and ensuring that the environment is clean. And also, this 1.5 withholding tax on scrap metal, it is being slammed on the gross turnover rather than the actual net income. So the actual net income, this means after deducting all the relevant expenses. So it is being taken from the gross turnover of the scrap metal. This is a lot of money because it is being taken without considering the expenses which need to be adjusted before you get the net profit of the scrap metal which you do. I know it involves a lot of cost, and that in a lot of scenario it usually seems like a straightforward business, but it has a lot of charges. Also, the clause 4, which was also also contested, and it is also receiving a petition in the court from the Consumer Federation of Kenya, COFEC, is the Mitumba second hand code reclassification trick. So the clause basically, it is under the clause 31, Mitumba and used footwear, which were shifted from zero rated to tax exempt. So shifting them from zero rated to tax exempt, what basically this means is that now the trader will not be able now to claim input tax, because when a commodity transferred to exempt, you cannot be able to claim for input tax for this commodity. So the backfire for this is where the government argues that this protects the local textile industry, which from time immemorial is a dead industry, without applying a direct 16 VAT. Opposition and lawmaker trader point out that the hidden danger, being tax exempt, be the trader can no longer claim the input VAT, as I said, and on the operational cost will rise, which will inevitably force them to raise the price to cover the difference. So this is they try to slam Mitumba in as many ways as possible. As you remember, I had already touched where there was an introduction of 5% withholding tax, which was deemed to be 5% of the custom value of the Mitumba. Before you sell the Mitumba, the importers were being slammed by 5% withholding tax of the custom value of the Mitumba cloth. So they have tried to fight this thing, but in most scenario, the local textile industry has never resurrected, despite how it have been tried to be breastfeeded. But I think it is high time we allow competitive advantage. If this local industry cannot be able to compete with the international market and the local Mitumba, it means there is no competitive advantage, and we should give the Kenyan consumer the liberty to choose what they want without hurting what they should consume. I know our manufacturing, maybe we have quality control, but it's not that the best rather than importing them. So we need to look some competitive advantage rather than introducing some punitive tax to try and solve something which will never resurrect. Okay, moving out from that, there was also another contested clause which clause in the bill, and which also the Confederation has already taken a petition in the court. The clause is the definition of the taxable gambling win, which has been expanded from withdrawn from the wallet to the paid or disbursed to the account of the player. So the backlash of this is it expands the tax base significantly by enforcing a 5% withholding tax on payout structured outside traditional online wallet, fully aligning to the tax code with the Gambling Control Act of 2025. So these are in a lot of scenario. I think a lot of people in Kenya are always against gambling, more so the older generation. But this gambling also is broadening. It has its market and it has employed a lot of people. So slamming these them with these withholding tax and reducing the net pay which is getting in the player account, it will discourage a lot of people from betting. So we can call it a sin tax, but what we should always remember, it is a sin tax, but it ends up employing a lot of people, and gambling, if well regulated, is a good industry which can help an economy to grow, and is not a bad idea. But slamming it with 5% withholding tax plus other taxes, I think it is unfair to the gambling industry. So it is gambling and betting payout loophole closure. So maybe they try how to cap this, but it's also contested by the Confederation. Going from that, the sixth one is the stricter corporate tax deadline. This is another elephant in the room, which is affecting every taxpayer. As we know, the deadline for companies to file their income tax self-assessment return has been slashed from 6 months to 4 months. So as we know, we were filing our returns from in the subsequent year after the year lapsing from January to basically June 30th, but now it's been strapped to April. What does this mean? It is tightening the compliance room, and a lot of people will be blocked when it comes to filing their return. So the financial officers and a lot of experts are one that this is condensing the window that will place a massive administrative burden on small and medium enterprises struggling with audit books on time. Since even during this time where we have 6 months to ensure we have reported or self-assessed ourselves the tax we need to pay to the revenue authority, you get even a lot of people are not ready up to the 6th month or in the month of June to self-assess and report what they have made. So technically what KRA was explaining, the reason why they are reducing this window, it doesn't hold any gravitas. I think 6 months was enough because there is nothing, it's just self-assessment, nothing else which is being done by the taxpayer. You need to give them time to prepare their book and ensure they have done everything correctly. Also, they slammed the filing of the nil return. You have up to 31st January to do your nil return. When that window pass, it is gone. Therefore, they are trying to tighten the self-assessing period or the tax deadline period, which is kind of develop a lot of problem because even the iTax system usually is not always able to handle massive number of people at the same time. So they will keep on extending this period, which I think is moving forward and then going back again, since the system will start generating a lot of flags when we adjust that period to few months. So basically, that is the highly contested past clauses in the finance bill, which I think it needed some review so that we make it clear what is happening. So even before the final vote, the Consumer Federation filed an urgent petition in the Constitution and Human Rights Division High Court to have the 6 of these sections, which they are controversial. However you try to view them, they are technically controversial areas, and the COFEC argued the bill violated constitutional provision on public participation, equitable taxation, and data protection. That is what I needed to share with you. In case you have any input, you can post it in the comment section. You can also reach me at a personal level using the contact in the description, where we can get through any tax complexity when it comes to VAT, income tax, and also consulting regarding various taxation system in Kenya. So thank you for watching and have a nice day ahead.